Hello, everyone. Welcome back to another edition of the Week in Charts. I'm your host, Charlie Bilello, and as always, I'm going to break down the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment, hit that subscribe button for more content just like it. A lot of important, interesting content coming out in the next few weeks, so make sure you're subscribed to the channel. What are we going to be discussing today? A lot of interesting topics, but number one would have to be the great rotation, an epic rotation going on in the markets. Has not been a quiet summer for the news cycle. It has not been a quiet summer for the markets as well. And I'm going to talk about the great rotation that's gone on over the past few weeks. Volatility is returning. First 2% down day for the S&P 500 since 2022. And I'll talk about, is that typical? Is that normal? Is this marking a change in the markets? And break that down for you. The expansion continues. Got a new GDP report. We'll discuss that. Consumer sentiment continues to be a very interesting data point because we're just not seeing the US consumer have any sort of confidence. It's really not matching up with the economic data, with the jobs data, and with the stock market data. Very atypical. Market is sending a clear message to the Fed here. You will cut rates in September. I'll tell you why that's important in terms of what the Fed actually does. It's all about supply. That would be the housing market. Data continues to trend in the right direction. If you're a buyer, it's just very, very slow moving in that direction. But I think it's good news, and it'll likely continue in the coming months. Q2 earnings update. We have about a third of the companies reporting so far. A couple of the big names here, Netflix, Tesla, and Google. I'll talk about those earnings and more. And we'll end, as we always do, with something positive. That would be the real-time inflation data is actually moving down and down pretty sharply here, which is great to see. All right, so let's start out with the great rotation. It has been an unbelievable 2 weeks in the markets here. We're looking right here at a chart of small caps minus large caps. The spread between the two in terms of returns over the last 12 trading days, record spread, almost 13% outperformance from small caps. We haven't seen anything like this going back to the inception of the first small cap ETF in May 2000. You can see here, pretty interesting that the two other periods where we saw huge small cap outperformance, well, they were also presidential election years. We actually saw it in November 2016 and then again in November 2020. So maybe there's something about presidential election years that gets people excited about domestic companies, or maybe this is just randomness, coincidence. But this time around, investors did not wait until November to get excited about small caps. They're doing it here in July, and we're seeing this record spread reversing the huge outperformance we were seeing year to date before this trend reversal. And it's not just small and large reversing course. We're also seeing value and growth. Growth, of course, had been outperforming value by an enormous margin in the past 12 trading days. That has reversed. Value stocks outperforming growth stocks by about 11%. And I think it's interesting and notable that the two other periods we saw huge value outperformance in short periods of time. One would be in 2000, late 2000, early 2001, when it was the aftermath of the dot-com bubble, where we saw just a multi-year reversal in terms of value outperforming growth. And the other period would be February and March 2021, which was kind of the peak of the high growth SPAC speculative fever in the markets. And then for a period of time after that, we saw value stocks outperform growth, only to see that reverse again over the past year and a half, with growth stocks taking leadership and actually hitting the highest ratio that we've seen for growth versus value since March 2000. So in terms of the breakdown, last 12 trading days, you could see here just an incredible divide from the winners who had been losers. Regional banks up 19% in the last 12 trading days, while semiconductor stocks, far and away the best industry group over the last decade, actually down 13.5%. You can see NVIDIA down 14.5%, and all of the big tech names, Microsoft, Amazon, Google, down, while the small cap index here up 9.5%, REITs up 5%, energy stocks up, value stocks up. So huge reversal in terms of of leadership. And it's not just a reversal in terms of these stocks are lagging, it's the fact that they're actually down while these other areas that have been beaten down are up. And if we look at that year to date performance gap that we had been talking about, just a record spread before the past 2 weeks, well, now that gap is closing. We had small caps roughly flat, large caps were up 16%. That was an enormous spread 2 weeks ago. Now that spread is less than 4%. You got small caps up now up over 10%, and large caps still up 14%. So interesting. But the question, of course, is, well, is the move done? Are small caps going to stop here? They're going to come back down. And I would come back to that study that I did in January, where we looked at the Russell 2000 being down 20% while the S&P 500 was hitting new highs. And what people were saying in the financial media, almost 100% of them were saying this is a bearish indicator. This is a cue for you to get out of the market because there's weak breadth. Stocks aren't participating. It's just a few stocks at the top driving all of the gains. And what we said at the time was the data doesn't support that view. If we look back historically, the times where the S&P was hitting new all-time highs and small caps were down a good ways from their all-time highs. We saw that in 85, 1991, and 1999. If we looked a year later, the stock market was higher each of these three times. And not only was it higher, we actually saw outperformance from small caps over that following year. So the tendency was actually for small caps to join large caps at all-time highs instead of the tendency that people were saying, which is we're saying, well, the large cap stocks now should go into a bear market to move down to small caps. And clearly we haven't seen that. We've seen over 30 all-time highs in the S&P 500, and you still have the Russell 2000 not at an all-time high just yet. But we're getting closer. We look at a total return basis, the IWM ETF, about 4% now off of its all-time highs from 2021. And the odds would suggest that this is likely to hit an all-time high at some point in the coming weeks and coming months. That seems to be much more likely. And the crazy thing is what we said in January was the exact opposite might be a bearish signal. So if small cap stocks were outperforming by a huge margin historically, looking out a year forward, that's actually been much worse for the market than small caps underperforming. So really, there was no data to suggest that this divergence here was negative for the markets, but that didn't stop people from saying it. But people will say a lot of things on financial TV that simply isn't true. So does this mark a secular sea change for the markets? Are we going to see value stocks outperform going forward, small caps outperform going forward, international stocks? Are we going to see all of the things that have been lagging become leaders? We'll only know that in looking back years from now in hindsight. But what we can say is entering these moves, we just had an extreme, we had a rubber band stretched in one direction. So we had that ratio of growth to value at its highest level since March 2000, the dot-com bubble peak. We had the ratio of large caps to small caps at its highest level since 1999. So these events here, I would say, that are occurring today aren't occurring in a vacuum. And wouldn't it be something if years from now we can point back to this 2-week period as marking that sea change for investors? So at Creative Planning, what we look at for people is making sure their portfolio can withstand multiple possible outcomes in the future. And if you're thinking about your portfolio today and how you're positioned for that future, well, reach out to us to get a free wealth path analysis today. I'll have a link to that in the show notes. Go to creativeplanning.com/Charlie, set up a call, set up a meeting today to get that free wealth path analysis where we're going to take a look at your portfolio. We'll make sure you're on the right path for retirement. We're going to look at your whole tax situation, see if there's anything you could be doing differently. And lastly, we're going to look at your estate plan, make sure you have all of your documents in order. So reach out today. Creative Planning, we're in all 50 states, over 300 billion in assets under management and advisement, and we're here to help. So make sure to schedule your call or meeting today, creativeplanning.com/Charlie. Number two, we got to talk about volatility here. And on the last week in charts, I was talking about the VIX and how little volatility we had seen this year. We actually had the lowest average VIX, 13.8, that we've seen since 2017. 2017 was an unusual year where every single month was positive for the S&P 500. And what we were saying is this is just a very low level of volatility, that investors have become complacent. We're seeing that in a number of different sentiment indicators. Looking at individual investors, percentage of bulls, 53% bulls of this AAII sentiment. That's the 93rd percentile. Investors intelligence, percentage bulls was at its highest level in years, 63.6. So markets were rising very fast. You had the S&P 500 up about 20% on the year, and investor sentiment had gotten to an extreme. And now, interestingly, while small caps have rallied higher, the S&P 500's pulled back a few percent. I think we got close to a 5% pullback this week, but we had that trading day where we had finally that 2% decline. It was the biggest decline we saw since December 2022 during the 2022 difficulties in the market. And so what we actually ended was this one of the longest periods we've seen without a 2% decline in market history, 356 straight trading days. That was the longest period without a 2% down day since 2007. And a lot of people have been saying that quote since 2007 without giving really any context to say just how different this is than back then. You're talking about that back then we went 949 trading days without a 2% down days, just historic multi-year period back then without a lot of volatility. Here, it's definitely abnormal to go this long, but certainly not nearly as extreme as back then. But a lot of people saying, oh, 2007, that was the peak of the market. That streak ended. And here we are ending a streak. And is this going to be the peak for the market today? But there's no way to answer that question. I think that's something that is interesting to look at, but you shouldn't draw a parallel to say just because the streak has ended that the market is necessarily going to start going down. Many times, if we look at the 1995 period where we had 526 straight trading days where the market didn't have a 2% decline, then it had one in 1996, and the market went on to continue to have strong years in 1996, 1997, 1998, 1999 before peaking in 2000. So every time is different. Don't look at these things with very small sample sizes and draw any conclusions just from that data point. So if we're looking at the number of big down days historically, what we've been saying all year is this is a very mild year so far in any way you look at it. We hadn't had that 2% down day until this week, but this is not abnormal. Of course, most of the time you see a few of these. Sometimes you have years with zero. Of course, we saw 3 straight years with zero in 2004, 5, and 2006. But most of the time you have a few in 2022. During bear market years, you're going to have a bunch. You have 15 of these. And overall, at 9 down days, more than 1% with a more than 1% decline is very, very mild. The average year has about 30 during the whole year, and we're in July, and we only have 9 so far. So still below average in terms of volatility, and the VIX during this period of volatility is just coming back to normal. Normal is about, average is about 20. We had been very, very low, about 12 in early July, and now we didn't even get up to 20 during this about 5% market pullback. On Friday here, I'm recording this, and it's about 17 on the VIX. So just a return to normalcy. I would say this is not anything to write home about, and still very, very mild in terms of the year overall for volatility. Number 3, expansion continues. We got the new GDP report for the second quarter. It blew out expectations. The consensus estimate was 2%, came in at 2.8%. This is that quarterly number, annualized higher. So you can see big uptick from the prior quarter, 1.4%, double that growth rate for the second quarter. This is the first reading that could be revised lower, but certainly much better than expected. And what's driving that 2.8% number? Here's the contribution. Biggest contribution, once again, was consumer spending on services. And I've been talking about this, but this has been the trend. Consumers certainly don't seem to be tapped out when it comes to spending on services, especially travel. You're just seeing huge demand, record demand this summer in terms of airlines, cruise lines, hotels, anything travel related. The US consumer appears to be in a very strong position and they're spending. And you can see the rest of it here: inventory growth, non-residential investment, consumer spending on goods bounced back. It was actually down the prior quarter, bouncing back to positive territory. And government spending continues. And next week, I'm going to talk about the fiscal situation in the US. And we're likely, I think, in that next week in charts report, going to be talking about a new national debt milestone of 35 trillion. So a lot of government spending going on, deficit spending, borrowing money, sending it out there. And that's certainly part and has been a part of this economic growth story. And that's continuing in the second quarter. And if we look at year over year growth rates in terms of real GDP, we could see even higher than that 2.8% number. And we're up 3.1% year over year. So certainly still seems to be strong growth in the U.S. economy. And in terms of the expansion now, we're at 51 consecutive months of expansion in the U.S. So expansion started April 2020. That's when we hit the low point during COVID. And since then, we've been in expansion now over 4 years in duration. Does that mean we're due for a recession? A lot of people are saying that. There's no magic number in terms of recessions, in terms of how long expansions can go on for. You could see the last expansion was a record in terms of the length, went on 128 months. So we're obviously nowhere near that. The one before that was 73 months, then 120 months, 92 months. So since the early 1980s, we've seen long expansions, much longer than what we've seen so far, 51 months. So certainly 51 months is not a reason to suggest, oh, it has to end right here. It certainly can continue for many more quarters. Doesn't mean it will, but you can't be looking at that and saying it's going to end here because it's 4 years old and the average expansion is 5 years. And so therefore we're due for a recession. It just simply doesn't work that way. Number 4, the curious case of consumer sentiment. This has been very bizarre and strange to me. And it's just a weird situation where the polling data, in terms of asking consumers how they're feeling, doesn't match up with what we're seeing in terms of actual consumer spending. So this is a clear case of watch what they do, not what they say. And what they've been saying since 2022, really, since we saw that spike in inflation, we've seen this consumer sentiment index hit a record low back then in 2022, which was very bizarre because usually you see this thing plummet during recessions, during bear markets. We didn't have the recession, we did have the bear market, but back then it was really about inflation. And the amazing thing is today, if you look at some of the responses to this consumer sentiment index, it still seems to be about inflation, even though the CPI has come down to 3% and it was at 9% over here. Still, people are very angry and upset about inflation. It's just this weird situation where we're not in a recession, at least not today. We still have the unemployment rate relatively low at 4.1%. We have the S&P 500 hitting all-time highs every other day this year, it seems like. And we have consumer sentiment in the tank. So really new historic period here where we're seeing this weakness in consumer sentiment, even though we have a strong stock market and even though we have the economy still in expansion. So what is it going to take to turn this thing around? I guess it would be just inflation coming lower. 3% doesn't seem to be enough. Maybe if we get down to 2% or below 2%, maybe that'll change this. I don't really know. For now, it seems like this is a broken index. The only thing I would say is in terms of looking at retail sales, so just looking at retailers, this has been, I would say, somewhat indicative of a slowdown there. If we look at retail sales, you can see, especially adjusted for inflation over the past few years, spending much more time in negative territory than positive territory. Now, this doesn't cover all of consumer spending. It's not looking obviously at that important services side of things, which is enormous in terms of consumer spending. But if we're just looking at retail sales here and we're being objective, we would say, yeah, over the past 2 years, certainly below average in terms of the nominal number here. We're over the past year up 2% versus 4.6% historically, and inflation adjusted, people do seem to be pulling back, at least in terms of their spending at retailers. We're certainly not seeing it in terms of services and the rest of it. So will be interesting to watch this chart. Maybe it's broken, maybe it's not. In terms of a sentiment indicator, historically, it's been better in terms of being an investor to buy this thing at low points. We certainly saw that in 2022 when we hit a record low. Stock market's done very well since then. But now here we are, just a crazy situation with the stock market, hitting so many all-time highs this year, and with sentiment so low. So I'll continue to watch this, but perhaps it doesn't mean as much as it used to mean. Perhaps that inflation picture has really clouded people in terms of their ability to evaluate their feelings. They're angry about inflation, but they still seem to be spending for now. Okay, number 5, market is saying to the Fed, you will cut rates in September. Why am I saying this? Because if you look at the Fed fund futures data and you break down in terms of for that September meeting, the odds of a rate cut in September, we're now at 100%. And so what the market's essentially saying is there's 86% chance of a 25 basis point cut, and then there's a 14% chance they'll cut more than 25 basis points. I don't think that definitely won't happen, 25 basis points, unless there's a crash or something crazy happens between now and September. 25 basis points, all the market's going to get. But this is important because the Fed always does what the market expects it to do. There is no idea of a surprise anymore at a Fed meeting. So the Fed's going to meet next week. And what I think that they're going to say is that they're going to cut rates in September. Maybe they won't outright say it, but they're going to give every indication. They're going to telegraph that move at the next meeting, at the July meeting. And then all of their speeches between July and September will be telling you why it's time to cut rates in September. And by the time we get to that meeting, it's already priced in at this point, by the time we get to that meeting, it will not be a surprise at all. So what is the question now? We got to move past that September meeting. This pretty much seems like a done deal at this point. We're looking now at the meetings after that. We got November, we got December. And what the market is saying now is that the Fed is not going to stop in September. They're going to cut rates again in November and again in December, and end the year at about 4.65% in terms of the Fed funds rate. Now, is this going to hold? No, it's too early to say that. So we get that September 25 basis point cut. Seems like it almost definitely will happen unless some crazy inflation report comes out between now and then. They're likely to cut because the market is already expecting it. But November and December, those we can't say, because you could have data points after that September meeting that kind of says to the Fed, well, let's just hold off here before we do another 25 basis point cut. And if we look at some of the comments here in terms of Fed members, Waller, is saying the time to lower the policy rate is drawing closer, and they're saying that it's a time to put more attention on maintaining the solid jobs market. So that's what we talked about in the last week in charts. Got the unemployment rate now 4.1%. So that balance is shifting. A year ago, when it was at 3.4%, the balance was all the way on the inflation side. And now it's getting more to the middle there, where they think that they need to focus on employment. They want to keep the labor market in the sweet spot. And you got Williams saying that even if and when the Fed starts to lower rates, they will remain at a setting that restrains economic activity. Restrictive policy that we have in place is appropriate. So what he's essentially saying there is, don't read too much into that 25 basis point cut, because we're still going to be restrictive at that point. And how do we measure that? Well, simply look at the Fed funds rate versus the Fed's preferred measure of inflation here, core PCE, which remains at 2.6%. We got the latest reading for the month of June, 2.6% year over year. You got the Fed funds rate at 5.25 on the lower bound. So that spread is the most restrictive monetary policy we've seen since 2007. And the Fed is essentially saying it doesn't need to be this restrictive anymore because inflation is moving back to their 2% target. They don't need to wait to get to 2%. They don't want to wait to get to 2% because they're saying now employment is becoming an issue and they don't want to see the jobs market really weaken substantially before they start cutting interest rates. So what they're saying, we'll do that 25 basis point cut, and we'll see from there. That's still going to be restrictive policy because you're above the rate of inflation. And it is a meeting by meeting thing, but the market is essentially saying the Fed is going to cut 3 times this year, which interestingly, that's what the Fed projected coming into the year. So it'll be interesting if in the end the Fed actually does what they projected they would do, which was to cut rates 3 times in 2024. It's very rare that that actually happens where those two things are lined up. Usually, the expectations and what actually happened is a big difference between the two. All right, I want to talk about the housing market. It's all about supply. I've been saying that for months now because supply has been so low. It doesn't matter that demand has collapsed because supply has collapsed even more. If we look at activity here in terms of existing home sales, you can see just crazy, crazy low levels of activity in existing homes, almost at the lowest point on record here. We had a little bit of a lower reading back in 2010, but just very low numbers, down on a year-over-year basis. Again, 5% over the last year. This is the longest period of negative year-over-year home sales. So activity since this period from 2006 to 2009. So you got to go last housing market bubble peak to find a similar period of slow activity. Now, this has been the issue in terms of why prices haven't been coming down, even though demand has collapsed and activity has collapsed. It's because inventories were at record lows, and that lock-in effect, people were not simply listing their home, they weren't moving because they wanted to keep that existing mortgage that they had in place, which is oftentimes below 4%. And they couldn't afford to move because if they did, they would have to get a mortgage at around 7% or higher. And what we saw is a record low in terms of the inventory month supply for existing homes. Now, slowly, this is shifting here. 4.1 now in terms of month supply, still low, but highest we've seen since 2020. And what we're seeing in terms of new homes is even higher in terms of the month supply, 9.3. It's very rare to see this outside of recessionary periods, to see supply this high in terms of new homes. So why is supply rising? You're seeing a combination of factors. Number one would be that affordability factor. So it's still very much unaffordable for people to buy these homes. So demand is low, but slowly you have people needing to move, wanting to move, and that lock-in effect becomes less and less important. And what we're seeing is listings go up in terms of existing homes, and we're seeing the inventory of new homes build as well. Here's a crazy stat here because of this divide between new homes and existing homes, because the supply of new homes has been much higher than existing homes. What we've seen is actually a cap on new home prices over the past few years, while existing home prices are at record highs here, up year over year. You can see this divergence. You got in the dark blue, existing home prices hitting a record high again in the month of June, and you have new home prices here well below their peak from a few years ago. So what we're seeing today for the first time in history is this spread between new home prices and existing home prices go negative. So the median price of an existing home is actually about $10,000 higher than the median price of a new home sold. Now, this isn't comparing apples to apples. Obviously, if you have the same size house in the same location, in terms of a new home and existing home, the new home is going to cost more. This is just looking at all of the homes sold in the US, the median prices of those. The new home prices have come down because builders are building smaller homes because the bigger homes are not affordable. So that's one big factor, they've come down. And also because the existing home market has just very little supply. So you're getting a better deal dollar for dollar, it seems like, if you're looking at a new home, because the supply of existing homes has been so low, home builders have been much more aggressive in terms of providing incentives and cutting prices to try to get closer to what people can afford. So just this very wacky situation. I don't suspect it will last for very long, but interesting to see this median price of a new home actually lower than the median price of an existing home. And this is the chart to watch here. It's looking at active listings of homes for sale, all homes in the US for sale. So new construction, everything, existing homes. And what we're seeing is a 19% increase of homes listed for sale over the past year. It's a combination of factors here driving this. One is homes are taking longer to sell. We have more new listings coming to the market. And what we're seeing is that affordability equation that we've been talking about has just gotten worse over the past year. So demand has come down and homes are taking longer to sell. So is this marking a shift? I think so. How much of a shift is it going to be in the coming years? We'll have to see. We're still not at a level of normalcy for the housing market in terms of supply. We need a lot more supply to come, both of existing homes and new homes. But hopefully, this will be a trend that continues, because it's not a good situation that we're in now with houses being unaffordable to most buyers that are out there looking to buy them. Okay. Number 7, we're going to talk about earnings here. Second quarter earnings coming out so far, pretty good in terms of overall. We're up 4% year over year. Another positive quarter for the S&P 500 operating earnings. But I think expectations, when we're only 35% into it, but expectations were definitely much higher than this. And why am I saying that? Because if you look at the S&P 500 over the past year, up over 20%. So you have 4% growth in earnings, 20% increase in prices. That's a big gap. That means, to me, expectations were high. Another way to look at it is to look at a PE ratio and look at price to peak earnings. And why do I look at price to peak earnings? Because you often get a distortion if you're looking at trailing earnings during periods of a recession. When earnings decline, it makes stocks look expensive when they're actually cheap. I think the best example of that would be back in 2008, when stocks looked very expensive on a trailing 12-month basis because earnings plummeted when they were actually cheap. So taking the current price of the S&P 500 and putting it over the peak earnings up to that point in time is, I think, a better way of looking at it. If we look at it that way, heading into this earnings season, you had the S&P 500 trading at 25.9, almost 26 times peak earnings. That was the highest we've seen for the S&P 500 since the year 2000. So stocks certainly not cheap. What they are expecting here is obviously earnings growth to be enormous in the coming quarters. So far, we're not seeing it for the second quarter, and perhaps that explains in part the reaction we've seen so far in terms of the companies that have reported: Netflix, Tesla, and if we look at Google, all of these stocks actually traded lower after reporting earnings, and perhaps that's simply a function of expectations. Because if we look at Netflix, just looking at the numbers, seem to be pretty good, up 17% year over year in terms of revenues. Subscribers beat by 3 million. You have another record high in terms of subscriber growth. So all of the moves that Netflix has made in recent years, especially coming up with that paid tier, that lower price where if you're going to watch ads and you'll get a lower price for it. Well, that seems to be a booming business for Netflix, and they can't even project yet how much that's going to add to the bottom line, because it's still too early. And what that's doing in terms of profit margins, it's substantially boosting profit margins for Netflix at a record high. Net profit margins now 19.5%. Netflix is not going to report subscribers after this year. So this will be last few quarters we're going to see subscriber growth. They want to focus, they're saying, on margins and revenues now that they're a more mature company. Netflix stock, though, sold off on this news, which seemed to be positive news, sold off. So interesting to see that reaction. Google, similar stock, had been doing amazing heading into earnings. Report seemed pretty good, 14% year-over-year revenue growth, which is hitting almost another record high. I think it was a record high for second quarter revenues. Historically, net income, I think it was the second highest quarter, up 29% year over year. But what investors were talking about was the fact that expenses are going up for Google. They're spending a lot on this AI build out. The projection for this year is that they're going to spend 49 billion on capex, which is over a 50% increase from what they spent in 2023. Here's a quote from the CEO of Google: "The risk of underinvesting in AI is dramatically greater than the risk of overinvesting." So they're making a bet here. Google's not alone. All these big tech companies spending a lot on AI, saying they have to do it. If they don't do it, it's an arms race, essentially. If they don't do it, the risk is too great. We'll only know in a few years if that's a good bet that they're making. But now the market's starting to become a little, I think, skeptical, and perhaps they're worried that this is going to eat into profitability in the coming quarters. The fact that they're going to be spending this much, and we won't know the actual gains perhaps for a few years from now. So unlike Nvidia, which is clearly benefiting right now from all of this build out, all of this capex spending is going to the bottom line of Nvidia. These other companies are spending money here, but we don't know yet the benefits in terms of future net income for companies like Google. Lastly, I want to talk about Tesla. Tesla revenues are up 2% year over year, but this is looking at all revenues. And if we break down automotive revenues, are actually down 7% over the past year. I think that was a disappointment for investors. Stock had run up significantly in the month prior to this earnings report, sold off double digits after the report. We've looked at net income. This has been the big problem for Tesla over the past few quarters, just a huge decline in net income versus last year, 45% lower than where it was a year ago. And the big reason for that, obviously, slowdown in demand. So you have revenues coming down in terms of automotive revenues. But the bigger factor is those price cuts that we've been talking about. This is just a chart looking at used prices, but Tesla doing enormous 30-40% cuts in terms of pricing on its vehicle, and that's hitting the bottom line. Here you're looking at the average used price has gone from a peak of 67,900 to 30,900 in the span of 2 years. So 2 years, enormous decline in terms of the average price of a Tesla. The bet in terms of Tesla is making is that they need to do this. They need to make cars more affordable because the consumer doesn't have the ability to buy these expensive cars because financing costs are so much. We're looking at the highest interest rates on car loans since 2001, 8.6%. And what Tesla is making a bet is to get as many cars as they can on the road as possible. So where would Tesla revenues be if they didn't make these cuts would be an interesting question to ask. But for now, market's punishing Tesla for the slowdown in net income, and Tesla is making a bet long term that this will be good for profits, let's say 5-10 years from now, just getting more people in Teslas, more cars into the ecosystem. But if we look at the reaction, this is the past 2 weeks. Netflix, not down a lot, but lower. Google and Tesla, all lower than 2 weeks ago. And next week, we'll get a bigger slew in terms of earnings. So we'll take a look at the reaction there. Always important to kind of look at expectations in terms of how companies react to that report. So there's the actual data, and then there's how the companies react to it. I never believe when they say the companies beat, they always beat the estimates. So Google beats, Tesla beats, everybody beats the estimates because the estimates are always, it's a game that they play, are always below what they're actually going to do. But it's not that reaction that matters. What matters is the market's reaction, how the share prices actually do. And this is coinciding, of course, with that big rotation that we talked about, where many of these growth names still trading at high price to earnings, high price to sales are now getting hit because the share prices have run up far faster, far higher than the actual fundamental performance. So what we're seeing here is a very minor so far multiple contraction in some of these high growth names. Again, very minor. You're talking about a multiple expansion enormous over the past 2 years, and now we're seeing a little bit of a pullback. So will be interesting to watch as we get the other big tech players report in the next few weeks. Want to end, as I always do, with something positive. That would be inflation moving down. So we talked about consumer sentiment still in the tank. The big reason for that is people still concerned about inflation. Prices aren't coming down. The rate of inflation might be going down, but prices aren't going down. But I think this is a positive data point here. Truflation looks at real-time inflation data, trying to say what the actual inflation rate is in the US. Their methodology is different than CPI. CPI, of course, is saying inflation's at 3%. The way Truflation is breaking it down, they're saying inflation is actually 1.68% over the past year. And that would be the lowest reading that we've seen in some time. And you could see here the trend over the past year, definitely lower than a year ago. So if this is accurate, if it's more accurate, obviously this is good news. Either way, any way you look at it, you want to see this chart moving down, whether you agree with this number or you think that it's actually higher. I don't think matters as much as the direction of it seems to be moving lower. If you look at things like gas prices, it's about 11 cents lower than a year ago. So certainly good news, summer travel season. A lot of people do a lot of driving, and gas prices, not cheap, but not as expensive as they were a few years ago. Certainly when they hit a record high of $5 a gallon, now we're at $3.50 a gallon. And if gas prices just stay flat, right, over the next few years, that's a win because your incomes are going up, and on a real basis, it's becoming more and more affordable. So similar to the story we've been talking about with rents, where rents in the US are actually lower than they were in 2022, asking rents every month that goes by where they're not hitting a new high and wages continue to go up is good news because that becomes more and more affordable. Okay, with that, we'll end it right there. Covered a lot of ground today. Thank you everyone for joining me on the Week in Charts. If you're watching this on YouTube, hit that subscribe button. Have an awesome weekend, and I'll see you next time on the next edition of the Week in Charts.